Friends, in this video for iThought Advisor, I'm going to talk to you on the topic why mutual fund selection is not so simple. That may sound like a very different statement, but truth is that most of the simplification of decision making in mutual funds has happened without proper analysis and judgment. Why do I say this? When I go and buy a stock, I look at the future potential of the stock. I look at how that particular company would perform over the long term. Now, how do people do the same decision when it comes to a mutual fund? They are looking at past performance. The most sophisticated analysis of mutual funds takes something like a 3-year rolling return, which is only a data torture of past performance. It's not really analysis. You may again wonder why I say this. Because the investment style of people can not adapt to situations. Some people do the same thing again and again. And if a fund manager did that, then when the market context is changing very rapidly, his style of investing will not be able to easily adapt to that changing context. More so, if he has made it some kind of a fund management statement. Suppose he said that, oh, I will own only these companies. I don't mind what is their valuation, but I will buy only these kind of companies. My portfolio will always have only this genre dominating it. And even if it's a large cap fund or a blue chip fund, that fund manager can become a prisoner to a particular way of investing. Market context need not be a prisoner to that way of investing. Market context will keep changing. So, the fund manager who is somewhat rigid in his approach may not be able to capture the changing context, especially if his approach has worked well for a period of time and he has kind of institutionalized that approach in the eyes and mind of the investor. This happens all the time. Let me give you an example. A few years back, a simple decision like selecting a large cap fund, which is a Nifty centric fund. Here again, everybody was veering around to a fund which was buying high quality companies at very expensive valuations. Now, bottom up, I asked myself the question, will I buy these companies? The answer was no. But that fund at that point in time had the best rolling returns. It looked like it had done phenomenally in the recent period prior to that and had a 5-star rating from everybody. It was in the top quartile. Roll 18 months to the present. The ranking of that fund is 25. Just imagine. What happened? The fund manager was rigid and he did not do what it takes to adapt to the changing market context. Now another fund manager who was having a very rough time at that moment, who had one or two difficult decisions which didn't work out or which actually affected him. He has worked the same period, worked on his fund, transformed it and made it into a winning product which is now in the top quartile, in the top 3, right? If you were the type who tortured data and arrived at your decisions, you would have picked the fund manager whose past performance looked fantastic. But as I told you, equity investing is all about the future. Whether it's a fund or a stock, you have to go granular to the company level to understand how the fund manager is positioning himself. If you look at just returns, then you're going to miss this completely. And precisely this made me think that the fund manager who was not preferred is a better fund manager than the fund manager who was the darling of the market, right? Now, this is not restricted to large cap or the current market context or the last 2 years. I have seen this happen for the last 11 years, and the way to pick something is through granular, specific, focused research, right? And that, in my opinion, is not meant to be easy. It is not something which can just be deciphered from basic data of the past, right? Now, this basic data doesn't tell you anything about the fund manager's current portfolio, his state of mind, his investment approach, his market alignment, and his futuristic bent. All these things are qualitative parameters, and these parameters should be looked very closely before you make an investment decision. So, if you are one of those who wants to make your own decisions, then I would strongly advise you to get these aspects into your mind, to internalize them, to understand their impact, and then make your choice. On the contrary, if you are simply a person who wants to look at data and make up your mind and invest, I would caution you that the data doesn't tell you all these things. So, mutual fund investing is not something that is meant to be demystified. Don't oversimplify it. It has complexity in analysis and decision making. Make sure that either you have that ability to interpret that complexity or you have the right assistance. Happy investing.